time. Pankaj Murarka is with us, CEO and Chief Investment Officer at Renaissance Investment Managers. Pankaj, good to have you back on the program. Thanks very much for your time. At the margin, you think this, if there is an interim deal, India-US, it provides, will that be seen as a bit of a trigger? And I'm only asking you this because over the weekend we learned from sources that they're not ruling it out. At least government sources are not ruling it out. And that perhaps because if you don't get an interim deal and then talks continue on a wider deal, perhaps the rate reset is pretty steep. I mean, that 10% base plus 26%. We don't know if that is going to be the rate if we don't get an interim agreement in place. But do you think that is also kind of weighing in? And if that an agreement is signed, it acts as a bit of a trigger? Pankaj.
Morning, Prashant. It's anybody's guess which way this goes, whether we get an interim one or a full-scale deal. But I still believe that eventually, irrespective of the fact whether we get an interim or not, even if there's some higher tariffs in the interim, I still think there could be a carve-out in terms of extension if they're not able to reach a deal with India. And eventually we get a deal and probably we get a tax treatment or a tariff structure which is similar or slightly lower to some of the other bilateral deals that US has done with the larger trading partners, including Japan and European Union. Net on an aggregate basis, I do not think it moves at the aggregate Indian economy level. I don't think so. It moves the needle in the near term over the next, let's say, 6 to 8 quarters from a growth perspective. So the fact is that the economy has lost some momentum over the last year. And probably I would like to believe that there's an economic reset. So if you see post-COVID for 3 years between FY22 and 24, the economy was growing at 8%. Last year, our growth slipped to 6.5%. And I think probably somewhere around 6.5%, the new normal for the economy for the next 2 years, probably this year and next year. Because the pent-up demand that we had accumulated during COVID lockdowns, that has run out of steam. And also, I must say at margin, the government did significant reforms pre-COVID. Probably we've reaped benefits of those reforms and they're already in the base. So probably the economy needs fresh trigger. The government has, I would say, given significant fiscal stimulus in terms of the tax cuts we had in the budget. On top of that, RBI has cut rate by 100 basis points. So that's a very significant monetary stimulus. Combination of the fiscal and monetary stimulus, I think probably we have an injection of $25 billion into the economy, into the hands of the consumers. And I think the next driver for the economy will be a recovery in consumption as this monetary and fiscal stimulus starts playing out or coming in the hands of the consumers from the second half of the year. So,
Hi, Pankaj.
Sorry,
go ahead. No, you're making that point. You still think?
No, I was saying that probably we have a downward economic reset at about 6.5% growth. And I don't think so this deal will move the needle either way. It's good to have that deal so that it does not have an adverse impact on some of the sectors which have a higher share of exports to US.
Hi, Pankaj. Good morning. Good to see you. And I think that's the uncertain event is something that's plaguing the markets. Once we get whatever the percentage is, at least we can move ahead, right? Uncertainty is behind us. So we'll have to, see how that pans out. But let's talk about the big talking point this morning. TCS talking about pulling back 2% of the global workforce. Now, some would, the commentary, if you look at social media and the likes, is very, very skeptic. But actually, the management clarified it's not AI-led. It's a bit of a mismatch in skill. We'll have to take their word for that. But how do you see this pans out from here on? Now they've bitten the bullet. They've taken the bold call. And, we've seen some of the global peers. You look at Meta, Amazon, when they started those workforce cuts in 2022, from there on, margins started improving. So do you think this is an additional negative? Because as it is, we knew, right, that they're going to grow in mid-single digits for the next couple of years. Your take?
Yeah, Nigel, I take your point. So I don't think so this will lead into any downward revision in terms of revenue growth or earnings growth for these companies. And we need to acknowledge that, for example, when we talk about TCS, it's a very large ship, 6 lakh employees, over 6.3 lakh employees. They do have to and employee is the most important resource or the asset they have. And they do have to manage their resources in terms of demand supply economics. My understanding of it is that at least the tier 1 IT companies have been facing a slightly higher competitive intensity because for the last few years, at least 2 out of the global, top 7 IT players were on a weak footing, and now they've had a new CEO, organization rejig, if you look at Cognizant and one of the other large global players, and they're clearly giving some of these larger tier one companies, meaningful competition when it comes to large deals. And obviously, there's a slowdown in the discretionary spends have been held back in US. So I think there are business pressures at margin uh, as far as these IT companies are concerned. But when it comes to valuations, I think as it is, meaning the growth expectations are very modest that are priced into these stocks at this point of time. So I don't see a downward revision to earnings growth or revenue growth because as it is, as I said, those expectations are very modest. But I think it's a reflection of very tight demand supply environment that these companies are experiencing, especially the larger ones on large deals, which are getting very competitive. And these companies have to manage their ship.
Nigel, I was thinking about this, hearing all our guests and, hearing the TCS story over the weekend as well. I think the one difference between job cuts in the Magnificent Seven and here is that their job cuts are happening because it's a brand new technology, which is boosting growth. So shareholders are saying, okay, fine, we're getting great growth. It's coming at the cost of jobs. It's a new way of doing business. Well, that's the new normal. In this case, like Mr. Krithivasan himself has said, that it's not because of AI. It's not like TCS has hit upon a brand new technology that's going to let the revenue shoot up 20% tomorrow. This is because of tightness. Like, Pankaj is also saying, deal pipelines are tight. There's probably not that much work for the present skill set. So maybe the slight difference between the job losses globally and over here.
My limited point is it may not be the time to sell. It may not be the time to sell the stock. It is, a newsworthy note point and a news point, etc. But it may not be the time to sell because of this.
Yeah.
That's my limited point.
Only a sentiment issue, but we'll see. This is probably the first step.
We get back to the growth, margins, how they're going to evolve the business, uncertainty, spending in the United States.
And this is probably only the first step, like, we've been debating and discussing as well, that perhaps there'll be more steps ahead to spur growth. But anyway, Pankaj, hi, morning. To get to the other problem area for the market, that's BFSI. Look at the reaction to Kotak Mahindra Bank. The market's hopes were squarely pinned on banks, that they will deliver, and that will keep the market trajectory going higher. But first quarter has been disappointing. How are you looking at the frontline banks? And do you think this is just a passing quarter? We shouldn't get too pessimistic?
Morning, Surabhi. Just to chip in onto the last point and to Nigel's point, I completely agree. Just think about it. This kind of job cuts done by TCS and probably there could be some follow-on by other IT companies. Probably we are seeing now after a gap of almost 10 years. So for long-term investors, when companies get into this kind of a thing, probably a tough demand environment, probably I think for a long-term investor, that's an opportunity to buy and not panic and sell at this point of time, as long as you have a slightly more longer-term view. Yeah, I thought I'll just make that point. Surabhi, on banks, the results have been somewhat weak. I agree this quarter, but that's also because RBI has front-loaded rate cuts to revive consumption in the economy, and given the way the sector is poised, where your assets get repriced immediately and deposits get repriced with a lag, I think it was expected in that sense, except for few banks like Kotak and some of the banks which have shown some negative surprise on their asset quality. But I still think that we are in the last leg of it, and that's not an area of major concern. So I would still be positively biased on banks because I am still firmly of the opinion that we see a cyclical recovery in the domestic economy driven by consumption in the second half of the year, and which should drive growth in consumer loans. Apart from playing direct consumer stocks, whether staples or discretionary, banks is the second proxy play because they benefit out of growth in consumer loans. I would still be buyer into these banks, taking a view which is over a period of a year or so.
Okay, all right. Good to hear your thoughts as always, Pankaj. We look forward to having a longer discussion with you in the time to come. Wishing you a good Monday and a rocking week ahead as well, Pankaj.